This year was very quiet for the stock market until August. In a single day, the Dow sunk more than 1,000 points on August 5th, the worst day since March 2020, just after COVID appeared in the US. Now, what drove the markets to such a sell-off? And how did gold fare? And when does gold outperform equities? Let's start with what happened recently. There were a few events that occurred in close proximity to each other, creating a unique market opportunity. The stock market took a hit originally on Friday, August 2nd, after the jobs report was released. There were fewer jobs added to the economy than hoped for, and economists missed on unemployment numbers, which came in at 4.3% instead of 4.1%. Recession fears reignited. On top of that, the Bank of Japan raised interest rates, reversing years of policy and upending the yen carry trade. The yen carry trade was a simple arbitrage strategy. Investors would borrow money in the yen because interest rates were very low. They would reinvest that money in the US or other countries where the interest rate was higher. When the Bank of Japan raised rates, it changed the currency's value against the dollar and triggered margin calls. Investors sold off assets to cover calls. Stocks took a beating initially, along with most other assets. Gold took a short dip, then bounced back. At this moment, gold's already recovered. The Dow still down over 1,000 points. The resiliency of gold in comparison has created some media attention, leading people to ask the question, does gold outperform the stock market? Now, with a recent example fresh in our minds, we may be exposing ourselves to recency bias. And to counter that, we look at history and ask, does gold tend to beat stocks overall? And the answer is a little complicated. Asking this question often results in a lot of cherry-picked data. For example, we could point out that if you bought $1 million of gold on January 1st, 2019, you would have made over $903,000. The same investment in the Dow would have made you only about $670,000. That makes gold look very attractive. But what if someone told you you could have made about $200,000 more than the gold investment by investing in the S&P 500 instead? Of course, a gold proponent could also point out that had you invested in gold in 2001, that would net you a 521% return on your investment, while the S&P 500 falls behind at only 285%. See how the numbers dance. Anyone who has read the book How to Lie with Statistics knows that numbers don't always tell the truth, but we can get a more truthful answer by asking the question a little differently. The important question is not, does gold beat the stock market? That is a red herring. The important question is, when does gold beat the stock market? Followed by, does it really matter? And we'll answer that second one in a bit. Depending on when and how you invest, your investment will perform differently. There's no surefire recipe for success, but there are a couple of strategies with good track records that many financial advisors recommend and use. First, one of the most commonly known benefits of gold is that it's an asset class that does not correlate with the stock market. And there's one time in particular when that is extremely valuable, and that's during recessions. As we demonstrated multiple times in this video, the dates you set for buy and sell orders can greatly influence your data. However, multiple studies conducted over the years have all shown that gold tends to outperform in recession environments, with over 75% of recessions driving a sharp increase in the value of gold. Meanwhile, stocks tend to decline during this period. For example, gold appreciated from about $620 an ounce at the start of 2007 to $1,100 an ounce around the end of 2009, which was about a 77% gain. The S&P 500 went from $1,430 to about $1,100 in the same time frame, representing a 30% loss. Now, this is an extreme example, but it's not an uncommon result during recessions. And in the last 3 recessions we've had, gold has performed well, driving a positive return each time. And stocks have not weathered those periods as gracefully. It's not a question of investing in either stocks or gold, though. There are plenty of years when the stock market returns have been amazing, and putting all your eggs into gold would have yielded suboptimal returns. Some years the stock market delivered returns over 20% while gold languished. With all the variability and the complexity of two very different markets, most financial advisors would recommend you avoid attempting to time the market. And the question of whether gold or the stock market wins really comes down to timing. Most advisors usually recommend following a dollar-cost averaging strategy by buying regularly over time instead of trying to time it. But there's another concept in investing known as risk-adjusted returns. Your regular returns are straightforward. If you invested $100 into stocks, made $10 on the investment, then you made 10%. But let's say you had two investments. Both were $100, and both made 10%. One of them, you had a chance of losing 50%, while the other had a chance of losing about 10%. Which investment was better? Risk-adjusted returns assesses the risk you take when investing and adjusts your returns based on the risk. It's a way of investing that helps you make decisions about growing and preserving your wealth rather than gambling with your life's earnings. Analysts who have studied the impact of gold on a portfolio found returns were maximized when 20 to 30% of the investors' holdings were in gold. However, there were better risk-adjusted returns when portfolios were comprised of a smaller percentage of gold, between 5 and 25%. There are two important insights for the investor looking to maximize returns and manage risk. First, there did not appear to be any benefit to placing more than 30% of your wealth in gold, either for maximizing returns or managing risk. And second, a range of positive benefits is easily achievable between 5% and 30% allocation based on analyst models. So the next time you read the news and a provocative headline proclaims gold the unequivocal winner or loser against stocks, think back to this video. It doesn't matter whether gold or stocks are the winner or the loser in any given year, month, or quarter, because most investors are diversifying. And when you diversify, you want there to be some years when one asset outperforms the other to a greater extent. In fact, you need that to happen, or you have not properly diversified the portfolio. So our answer to the second question, does it really matter if gold or stocks win or lose in any given year, can be answered with a confident no. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.